Good afternoon, everyone. Welcome to our lunch webinar. We have invited Thibault DELBARGE today, who is representing Altaroc. The topic of today's session is not as such about taxation, although we'll go briefly into detail at the very end of the presentation into the tax implications of investing in private equity. But yeah, we thought it was interesting, and we get this question quite often from our clients. So if they understand what are the tax implications, or in terms of cross-border tax planning, the question also often comes up, where to invest in. Yeah, obviously, we are not financial advisors. We cover the tax side of everything, but the financial side is usually for, let's say, a specialist financial advisor. And for that reason, we have invited Thibault today, who joined us. I'm just going to start with maybe briefly explaining the formalities. So the purpose of today's meeting is that we will let Thibault do the talking. I will focus on the tax implications, as I mentioned at the very end of the presentation. If you have certain questions, you can drop them in the chat box. We will look at your questions at the very end of the presentation. I think it's going to be around 1 hour maximum. The webinar will also be recorded. So if Thibault approves afterwards, we will make it available on our YouTube channel. In terms of the, let's say, disclaimer, I want to make sure to everyone that they understand that the information shared in this webinar is for educational purposes only, does not constitute financial investment or legal advice. We are not licensed financial advisors, have no financial interest or gain from the investment opportunities discussed here today. For personal advice or investment decisions, we would need to ask you to consult a financial partner, Thibault, or a licensed financial professional. So now we have that out of the way, I'm going to give the word to Thibault, and you can hopefully explain us what is private equity and whether it makes sense to invest in it or not.
Perfect. Thank you so much, Gregory, for the introduction. I will share my screen. Hopefully this works so that I can put my presentation deck forward. Could you please confirm you see it?
Perfect.
Okay, perfect. So good afternoon, everybody. So my name is Thibault DELBARGE. Today we're going to try to explain a bit more what private equity is and how we can invest in it. So we're taking Wall Street to your street, and I think the full aim of this presentation is diversifying assets. So maybe to start, who am I? Because how am I to really know about private equity and what is my expertise? I've been working for more than 15 years in the asset management industry. I started my career at JP Morgan. I moved on to Degroof Petercam. I was country head Belgium, Luxembourg for Allianz Global Investors. And now I'm the country head for Belgium, Netherlands, and Luxembourg at Altaroc. I'm an entrepreneur, I feel. Reason why, and this might be interest to some of you, I have as well launched my own businesses, which I sold. I'm still doing some ventures. So I'm an entrepreneur at heart, but I'm always focusing on the financial aspects. And I'm trying to build stuff, but more importantly, and which has really given me a lot of purpose in life, is to help others really with building. And with building stuff, finance is always important. To make sure that you achieve your goals and that you can get your business thriving. Private equity, as it's heading here on the right side, was published in the Tate, the financial newspaper in Belgium. Investing in private equity should not be complex, and that is my whole aim today. I always say when I start my presentation, if I haven't convinced you by the end of it, then I haven't done a good job, but I'll try to guide you through step by step what is now the interesting fact of investing in private equity. Some people ask me as well, like, what is my ideal portfolio? Well, I believe I need to be diversified and I need to be leveraged. On the leverage part, I will touch on that on the end of the presentation, but let's start with diversification. And diversification, most people, when they start investing, they buy a stock, they buy funds, they go in everything of the listed markets. Private equity, however, has been specifically in Belgium or in Europe, being underweight, heavy underweight in clients' portfolios, although it's a very interesting asset class. The reason why private equity has not been in client portfolios is because it was very complex to enter. Minimum tickets raised from 10 to 20 million. so very high, very complex structures to try to invest in it. And Altaroc has been working hard to make sure that simplification is there and that it's easier accessible to invest into private equity. First of all, before we start investing in private equity, we need to try to understand private equity. I think the most interesting figure is 94% of all the businesses worldwide are not listed. And those are not the small businesses. It's not the baker on the corner of the street. It is businesses that have a revenue over $100 million. So 94% of the market is non-listed. So people that say to me, yes, but I'm already well diversified in the equity space. Well, you are maybe, but only for 6% of the full market of equities worldwide. And a lot of big companies as well are not listed. And trying to get access to that is not easy possible. It's not very easy. So only via private equity funds, you get that accessibility to the real economy. Now, explaining what private equity is, we have 4 stages of private equity. We have venture capital, so more the startup kind of space where not revenue has been proven. And if you're adding that into your portfolio, you need to be realistic with it, that on average, you'll only find out after 18 years if it has been successful, yes or not. So it's a more risky asset class. It's not an asset class that I would suggest to go in if you're stepping in as a first investor into private equity. And we at Altaroc, we do not have any venture capital in our funds. Another end of the spectrum is a turnaround capital. That is businesses that are under distressed. This is also not an area of where we want to focus on. We are focusing on growth equity and on leverage buyouts. So growth equity, businesses that are doing profitable but are needing some capital to grow. Leverage buyouts is mainly trying to invest into businesses which are already mature and profitable, but they want to have some finance and some debt, some leverage in it to make sure that they can grow even further. Now, although private equity has not been in client portfolios, if we're looking at the space, and this is only the space, private equity growth and buyouts, over the last 20 years, the average return was 13.2%, while the traditional market, the MSCI World, was 8.6%. So quite a big difference. Even if we're looking on 10 years, so a shorter time horizon, yes, the markets have been very good, around 10% on average, MSCI World, but private equity has done better, we're close with 15%. So a difference of more than 5%. If we're adding that up year on year on year, that 5%, well, that compounding effect will be a massive difference on the long term. Here as well, what I try to always do, and I was just discussing with Gregory on the beginning, just before the call, how long is the time horizon now? What I always try to do is look much longer term. If you're looking every quarter or every 6 months or every year, you're never allowing really the performance to compound on itself. And with the extra added value of investing in private equity, and this, I don't say you need to fully move out from traditional to private equity, I believe it's important to diversify, and that will boost the performance over the longer term. This is, of course, not a guarantee, because past performance is no guarantee for the future, but it will help to invest in the real economy. What are now the fundamentals of private equity? So it focus, as I mentioned, this is very important. We're investing in the real economy. This is very important. We're investing in 94% of all the businesses worldwide that are already stable, mature, and growing, but are just not listed. By not being listed, it helps that the management of those companies do not need to look every quarter at their quarterly reports, which means that the time horizon for a manager or CEO of business can be longer. The aim is always to grow over a longer period than just every quarter on a quarter. Interesting to know is that there's a full alignment of interest. When a management takes stake into the company's capital, the fund manager also invests as an investor. At Altaroc, we take that very high in our vein, and this is very important for us. Or 2 founders invest, they are the number 1 client of each of the fund that we launch. But as well, me personally, if you would ask me, and this is always an interesting question, if you have a private banker in front of you, which I'm not, is to ask, well, the fund or the product you're suggesting to me, are you invested in it as well? I always believe in everything that I put forward towards my clients is that I have as well an alignment of interest. I do my due diligence. Is it private equity or traditional? To look and make sure that I put my money where my mouth is and I invest alongside my investors. We have a long-term investment horizon. Implementation of 5 to 7 years to make sure that the value is created. So not focusing on that quarterly reports. We're using as well in private equity, it's very useful that we're using with, for example, leverage buyout. We use financial leverage to make sure that there's financial on the initial acquisition and as well for the further acquisition, so the build-up kind of phase. This is just a couple of elements to highlight what the fundamentals are of private equity. To focus on longer-term investments, less volatility because we give the investors a longer-term horizon and a fully alignment of interests. Now, the first number I talked to you about was the 94%, which is the market size of all the equities which are not listed. Now, the second very important element is returns. Because we've been showing that the average over the last 20 years was 13% plus. But now, what was the worst time? Because that is always where investors are looking at. For example, the dot-com bubble. For example, the subprime mortgage crisis. For example, COVID. As we see, since 1999, private equity has not shown any negative return over that period. Meaning as well, remember, I think everyone remembers very well the financial crisis in 2008. Well, markets went down 20, 30, 40%. You need to have a period built in to go back to zero and to positive terms. With private equity, there was more stability, and the worst performance was in 2005, an 8.5% return. So those are annual returns, no negative year, so more stability because there's a longer horizon afterwards for making the investments. So it's proven resilience. Now coming to, private equity, I tried to explain so that to diversify, you need to have, from my personal point of view, private equity into your portfolio, because otherwise you're missing the 94% of the market. Additionally, private equity has delivered on average 5 to 6% net returns on top of the MSCI World. So on top of the traditional equity sides, it has been year on year outperforming and with a lower volatility. 8.5% was the lowest return that has been given in private equity. So there's much more stable investment on a longer term horizon. Now, what are we trying to do? So that is understanding private equity, so investing into the real economy. What we have as well, and I would highly, and I will discuss with Gregory to send a follow-up, that to our website, you can see company by company, and I can show you an example afterwards, that you can, with full transparency, see in what you actually invest. So we showcase all our companies into our portfolio so that you have full see-through of what you're actually investing in, and you can read up all the metrics and the reasoning why we have that. So now explaining Altaroc and what we offer into private equity. So I shared with you, here ahead, when did we actually launch? So Altaroc, we're managing more than 3 billion euros. We have collected 1.6 billion euros in the last 4 years. So we are a private equity boutique. We're only focusing, the only thing we do is private equity, but we are pioneers in Europe, and we are one of the largest private equity boutiques. We've been founded in 1972, formerly Apex Partners, then Amboise Partners, and now that has been changed the name to Altaroc Partners. In 1995, we had the first closed-ended evergreen fund, the semi-liquid version, I would say. We do have now one opened up in 2025, which is an open-ended semi-liquid product. So if there are any questions on that, I'm more than happy to help you guide through this. What we're now focusing on is the Odyssey Horizon funds, which is close-ended private equity funds. So this is the primary market. This is the secondary market. With this product, we have been, as I mentioned, raised 1.6 billion euros over the last 4 years, which is much larger than any private bank has been doing. So we've been only focusing on doing that. Altaroc has been founded by Maurice Ticino. He's an absolute pioneer in private equity. He has been launching private equity almost in Europe. He has 50 years of experience. You see, he's a young entrepreneur, but he brings a wealth of experience with him. Aside him, the co-founder is Frédéric Stollard, an interesting, for the people in Belgium and the people that know Albert Frère. Frédéric has been managing for 20 years the investment arm for Albert Frère. And together with Albert Frère, Paul Desmarais, he launched Sagar, and he was the managing partner and the CEO of that company. He has 35 years of experience in private equity. So Frédéric from an ultra high net worth perspective, Maurice from an institutional perspective, both gentlemen have a wealth of experience in private equity. And what they wanted to do is bring institutional private equity to retail investors. We're active in 6 countries, 7 going to be launched. We're a team of 75 people, mainly based from Paris. And what we do, we have over 7,000 retail investors already onboarded. Now, what do we do? What we're going to try to do, our value proposition, we offer private equity a high potential asset class. So really providing the best. We're trying to do trying to select the best funds. And then for me, what is really the game changer is the RIO program. I'll guide you through what that is step by step, but that is really the key component from long-term investors. The vintages, what I discussed earlier. So coming back, the 3 figures which were important, 94% of the market is non-listed, outperformance for 5 to 6% year on year, and the lowest return was 8.5%. Now it gets even better. What we are trying to do with Altaroc is there's a big difference, as everyone knows, buying the best companies or the worst companies. So what we're trying to do is identify the first quartile investments. So which is less than 25% of the funds that have a consistent outperformance. If we're looking at the first quartile, that is the market we are, and that is our expertise to select the best funds, the best co-investments into the space, you see that over 20 years, we delivered a net return of 20%. Over the last 10 years, 22%. So with the gap, if we remember well, in 10 years, the traditional, the MICI world, the traditional space, so the accessible market was about 10% every year, 10% annual return. Now, with private equity, best of the market, we got 22%, which is an outperformance of 12% year on year. That makes a huge difference on the longer term. So making and selecting the best funds is really critical. How do we do that? Well, we invest into management companies that are existing over 20 years, that have achieved an objective of at least 2x net multiple, meaning you put 100,000 in, you get 200,000 out, or a net IRR, so the net average return of about 15% over the last 20 years. Very low volatility and capital commitments of over 1 billion euro. This is for me very important. If you analyze this and compare what is in there in the market, there's a lot of people that are investing into funds which have 100 million, 200 million, which is very niche. You're entering into a very small segment where there are more risks involved. Here you're buying in the asset class, the best of the asset class, but with proven track record, large enough to make sure that the risks are well maintained and well managed. And which is very important, what I mentioned already, with private equity, we need to see a significant investment by the fund manager so that we have a full alignment of interest. These are the financial criteria. We're looking as well at the non-financial criteria. It needs to be clear and precise investment strategy. So we do not buy any generalists. We want to have that they are the best of that specific sector, that they know that market inside out better than the companies they invest in, so they can add value, so that our portfolio managers can add value in those businesses. It needs to be a significant team. It needs to be well spread and have a specific geographic focus. And we do as well implement some ESG policies to make sure that there's a good governance in place, good environmental and social policies are met. So the fund is in Article 8 for people that would be interested to know that, which is a high standard on the ESG sustainability level. So how is now the portfolio constructed? We will have 80% of the funds allocated to 6 to 7 managers. Our job is to identify the best managers and the best funds out there so that we can build a nicely diversified portfolio. 80% in funds, 20% in co-investments alongside our managers. So we do an extra diligence on those businesses, but we will invest alongside our managers. We will focus on 2 sectors, growth, equity, and leverage buyout, which I explained. And with investing into one vintage, so one fund, one private equity fund, you will be invested into over 150 companies. So you're already very well diversified, which is very different than some of the master feeders, which are the banks rather putting forward, which will be typically 20 to 30 names. Here you're investing in a much larger diversified portfolio. So spreading out your risks. We focus on 4 sectors, 50% in software, 10% in B2C, 20% in B2B services, and 20% in healthcare. Why do we have such a specific focus? That can change, but those are the sectors we believe
When I called
today.
you, I was over there. Oh,
Why those specific sectors? Well, those sectors we believe that private equity can add significant value and see a lot of growth potential in the years to come. We will have as well a well-diversified geographical spread, 45% to Europe, 45% to the US, and 10% Asia and the rest of the world. Why is Asia and the rest of the world less? Is because private equity has not seen significant of transactions. You need to know that private equity has been launched about 60 years ago in the US and only about 50 years ago, 40 to 50 years ago in Europe. Asia and the rest of the world are 10, 20 years. So there are still some room for growth, but if we see an opportunity, we will add that into the portfolio. Otherwise, we split it out evenly between Europe and the US. Now, what is important for investors and most of you business owners is capital calls and cash flow. It's always crucial that we know in advance when the capital will be called to do the investments. And what we have, and this is why it becomes really truly simplified, is that we always have a very strict program. So we launch a new fund every year. We have launched five funds, and every year we launch a new vintage, a new fund, and then whenever you decide to invest, you pay 10%, and then the rest will be on the final close, which is on April. And then you know in advance, it's going to be 10% of your commitment, March, September, every year going after, because we will spread out the investments over 5 years. I'll go into detail on that. This is the subscription you don't need to look at today. For us, Altaroc, the next potential chance for an onboarding and the first close will be end of December. But this is something we can discuss afterwards as well, should there be any questions. How does it now explain now into detail those cash flows? So I take an example of 100,000 euros. You'll be invested. The capitals will be called over the first 5 years, which means 10% each 6 months. In the example of 100,000, first year you commit. You make the engagement for 100,000. The capital call is 20,000. The year after 20,000, year after 20,000, year after 20,000, year after 20,000. Important to know with private equity, you'll be invested for 10 years, of which 5 years there is capital calls. But interesting to know, after year 4, you're starting to receive, this is an estimation of distribution. So instead of paying 20,000 here, you'll have already received a distribution in year 4, and you'll have received a distribution in year 5, which means with 100,000 euros investment, an engagement for 100,000, the capital that you will be called is 80,000. From year 6, you get 40% back. From year 7, you get 40% back. So after year 7, all the money you have invested is received back, and the years after is the additional. This is now on an example what we have done. The performance targets net of fees, the performance target of the fund is about 13%. Why 13%? Well, that has been the average for the last 20 years, the average of the market. If we would look at how our portfolio has done, it was an annual return of more than 20%. But we need to always be a bit cautious, and that's why we believe we feel comfortable to put the average on the market, 13%. Of course, important to mention, past performance, no guarantee for the future, and this is not a guaranteed product. You're still investing in equities. You're investing with some sort of a risk, but what we have noticed over the last 20 years and since 1999, this is the information we put forward and where we feel comfortable that the real economy will grow over a longer period. The RIO program, that is really where the game changer is. So the game changer starts adding private equity into your portfolio, but as we all know, we don't know when is it this year the best vintage, or the year after, or the year after that. Timing the market, from my point of view, is very, very hard to do, unless you're Warren Buffett. But even then, I think sometimes he's been wrong as well, although he did an amazing, fantastic track record over his whole career. But timing the market, it is very, very complex to do, specifically as a retail investor. So you need to have a big team to follow up all of the movement that happen. And so what Altaroc came up with as a solution is the RIO program. What does that mean? Is that we're going to try what I mentioned to reinvest that 10,000 euros you receive in year 4 as distribution, and the 10% of distribution you receive in year 5. So what I mentioned, the 100,000 becomes 80,000, which means if people pay attention earlier, the multiple was here in a normal scenario 1.7, your multiple goes higher to 188. So we're investing, this is now on one vintage, you're investing, you know that you're locked in for 10 years, you invest for the first 5 years, but you receive distribution, which you will reinvest. So with the 100,000, you only need to allocate 80,000. Now it gets even more exciting, and I made an example on an investment over 775,000 euros over the next 6 years. I'll explain it in detail, but just to give you a little bit of a real example, a tangible example. And I put it here, horizon 30 years. For some people, they might say, yeah, this may be too long, but we all know that we live longer. We might think already of the succession for children. With private equity and with any investment you do in life, in my point of view, you need to look longer term because the markets are volatile. And yes, you might have a year which you have great performance, but the year after everything plunges. Over the end, it is from this moment you start investing until you exit that you see where the profit is going. And what I always try to do with my clients is explain, you need to think much longer to really have the full power of private equity, and then eventually, which I'm going to talk to you about as well, of leverage. So in this example, you're investing 775,000 euros over 6 years with a multiple of 17.5, which means 775,000 euros will be, after 30 years, 13.5 million euros. You might say that is impressive, that is amazing, but that is based on the average of the average of the average of the market, the 13%. So the power of compounding is very, very important. While using your distribution to reinvest, you're making the possibilities to spread it out and to make sure that you can truly build a full portfolio, patrimonium and wealth. How does it now happen into practice? Because cash flow is king and cash flow is the key to win long term. My apologies, there's a lot of numbers on this. What we're going to try to focus on is first the engagements, So each fund is an engagement of 250,000 euros in this example, knowing well that the capital calls is for the first fund, 50,000 year 1, 50,000 year 2, 50,000 year 3, 50,000 year 4, 50,000 year 5. As we're adding on every year, we're going to invest into a new vintage, because I do not know, is 2024 better than 2027 or 2030? My advice is always to try to invest every year into the market. Is it either traditional or private, but to make sure that you spread out your investments. And private equity is designed to have a longer investment horizon, which means it's very convenient to step in year after year. So you make the engagement for 250,000 euros, but you're only going to be called 50,000 year 1, 50,000 year 2, 50,000 year 3, year 4, year 5. So you're already automatically spreading out. Keeping in mind, if you're having one fund, which is about 150 companies, if you're doing that over 10, you're invested in more than 1,500, close to 2,000 companies. So you're making as well, you're reducing your risk and you're diversifying your portfolio. You're having access to private equity, you're having access to the real economy, you're having access to a more stable return profile, and you're spreading it out. That is, for me, very crucial. Now, why is this 775,000 a very interesting number to look at when you see that you continue to do investments? So I put it now an example for over 30 years. Well, we look, the appel de fonds, the capital calls being made, but as mentioned in year 4, you start to receive distribution. 25,000 year 4, 50,000 in year 5, 60,000 in year 6. So what you need to look at is this figure, the flux de trésorerie annuel, which means your cash flow. Year 1, you'll invest 50,000, year 2, 100,000, year 3, 150,000, year 4, 175,000, year 5, 200,000, year 6, 100,000. Total amount 775,000 euros spread over 6 years. What is amazing about this, if you keep on doing this, in year 7, you do not need to put any additional money investment into the vehicles, because your distribution will be equal than your engagement. In year 8, your distribution is higher than your initial investment, which means you end up with 63,000 euros positive afterwards. So you're starting to receive actual distribution, but you're keeping your money still at work. So year 8, you get 63, and year 9, 125,000, year 10, 126,000, year 11, 78, and it keeps on going. So your investments, your engagements increase because you're receiving more distribution, and in the meantime, your wealth keeps growing. And as we say, we live longer, we should invest for the future. I'll quickly now change to make this fully as a good example. We want to, for example, we want to have, for example, in 15 years, we want to have €1 million without any taxes. I'll let Gregory go on it. And then we can say we want to have it maximum in 15 years, you want to have €1 million. We have a tool. Okay, not high enough. Sorry. Yeah, okay, so we want to have in 15 years, €2 million. It shows exactly what we need to do to invest and receive at the end of the day 2 million euros. So this is an engagement of 182,000 every year that you need to invest, a total of 564,000 euros in over 6 years to achieve the goal of 2 million. You might say, well, I want to retire and I need 250,000 euros without taxes. What do I need to invest? Well, we can see we need about 1,110,000 spread invested over 6 years to come in 10 years to receive a pension of 250,000 euros every year. So with private equity, you have a tool to either create wealth as an endowment over the longer term, thinking very long term to create really wealth, or you might think as well, I need to have income. I need to have a pension to retire from. It is the same philosophy as investing into real estate. You're paying for your mortgage for the first 10 years of an investment property, which you're renting out. And then after 10 years, you get the income, the rental income. The philosophy is exactly the same. You invest into private equity, and then you get a distribution from your private equity investment. So you can create a full pension plan with private equity. It's the same mechanism, only private equity has historically shown a better performance if you're looking at the investment into the real economy. I don't say the one is better than the other. I always say diversify. So have some private equity, have some traditional, have some real estate, but know as well that you can build a pension plan with private equity. Interesting as well to mention as a last point on private equity is that you do not need to invest every year. You can say, I do an engagement of 250,000. Next year, it depends. You want to join, you don't want to join. It really fully depends to you. So the engagement is not 775,000. The engagement is done per fund each year, and then you do the commitments afterwards. I put it now the example to really show you the power of long-term investing, diversifying your assets, and using the tools to create a pension plan or to create wealth for yourself over the longer term. This is now, in a nutshell, what we do as private equity.
It's very clear and, say, informative session. I would say I'm convinced. Where can I sign up? But yeah, there's obviously a few tax considerations to keep in mind as well. So that's where I will hopefully provide some insight as well. Just a second. I'm going to share my screen. Is it visible? Thibault, can you confirm?
Yes.
My slides, please. Yes,
yes,
perfect.
yes.
Okay. So if I understood correctly, your funds are typically held in Luxembourg. That's correct. They are, let's say the investments are based in Luxembourg structure,
yes.
right?
The Manco is in a Luxembourg vehicle. Know as well, this may be an interesting one to mention for potential investors. You invest into the fund. So you are investing into a fund structure which underlying has investments into the companies which mentioned. I can as well, that would be interesting for someone, showcase some of these investments actually made. Yeah.
Okay. So it's a direct investment in the fund. Yeah, I know there's some, let's say, more exotic setups with a life insurance contract. We're not going to go into detail on that today, but yeah, it's usually a capitalization fund. And then, of course, as we see in your tables that you showed, that there is distribution possible. Now, Belgium sees this as a tax transparent structure. I know in Luxembourg, the fund has legal personality. I'll tell you in a minute for what that actually is relevant. The tax, let's say, analysis of the fund is, let's say, pretty straightforward. If you're a private investor, you can also invest with your, let's say, Belgian company. If you say, okay, I have excess cash, I'm not going to take it out. I'm going to invest directly with my company in Belgium. That option also exists, but that's what we will discuss in a second. The main focus here now is investing as a private individual. So any distributions, I don't know if there is dividend distributions, because I saw it on the slides you sent me before. Is that ever relevant? Are there funds that distribute dividends, or is it only focused on accumulating?
It's so the distribution is not dividends, which is indeed a very important implication on the Belgian tax. So as a private individual, you do not only the solidarity tax that you will discuss, but that is the only tax you pay. Yeah.
Okay. So any reinvestments, any increase in value, it should be, it's a typo there, it should be value. Any increase in value obviously has no tax implication for you in Belgium. When you come to a point of liquidation of your assets or a share redemption, up till now, as we all know, we have no capital gains tax in Belgium. We all know that's as under the flag of solidarity contribution that will change as of next year. But as it stands today, any investments that are holding more than 10% of assets that are debt instruments, they've come into scope of the Reinders tax. Reinders tax has been there already for, I think, over 10 years. In that case, if your fund exists of more than 10% of, let's say, bonds and debt instruments, then in that case, you will be liable for the Reinders tax. If not, today there is no capital gains taxation. As of next year, we're looking at a 10% solidarity contribution, as they call it, but it's actually a flat-out capital gains taxation. It will continue to exist next to the Reinders tax. For now, they're still working on the details of the solidarity contribution. Today's focus is obviously not to discuss the Belgian capital gains tax, but I can refer you to our website where we have a very, let's say, elaborate article on the new capital gains tax coming into play as of next year. So that's, of course, something that you may need to consider at 10% currently. If you're looking at an investment window of 10, 20 years, most likely the capital gains tax rate will go up. But that's obviously something we cannot predict at this point. What is also relevant is if your securities accounts, including the investments with Altaroc, are for a value exceeding 1 million euro, there is currently in Belgium the tax on securities accounts of 0.15%. They also mentioned that this may be increased over the next year or the year after. For now, it's still at 0.15. So if you're at 1 million, you pay 1,500 euro annual tax on the value of your securities accounts. So they take 4 pictures during the year, and the aggregate value of those 4 moments, if that exceeds 1 million euro, that will trigger the 0.15% wealth tax or securities tax. The tax on securities transactions is not applicable, so you don't need to bother with paying the transaction tax. So that's usually what comes into play when investing as a private individual. Another point of attention, and there has been a lot of discussion about this, especially on, let's say, more expert people that are into the Cayman tax and everything to do with it, the more expert analysis. So there was an issue of your fund in Luxembourg, in this case, potentially coming into scope of the Cayman tax. Again, the purpose of today's presentation is not to go into full detail and to bore you with the workings and the whereabouts of the Cayman tax, but if your structure is not distribute anything under the Cayman tax, any increase in value could come into scope of the Belgian look-through taxation, in case it could be classified as what they call a legal arrangement. Now, we can already, let's say, comfort you there. If the fund has multiple unrelated investors, which I understand is the case, and if it's managed by an independent, fully authorized fund manager, then normally it should not come into play or come into scope of the Cayman tax. There has been a recent decision of the Constitutional Court. It was actually a little over a month ago that the Belgian Constitutional Court specifically focused on the collective investment institutions and the funds like the one in Luxembourg, whether they qualify under the Cayman tax or not. Well, there was a bit of a discussion, but the Constitutional Court came to the conclusion that any taxpayer should be able to prove that their structure is not tax motivated. In that case, normally they will not come into scope of any Belgian Cayman tax. It's just a point of remark to give you a full overview of what is potentially triggered by investing in a fund like this. But that's it for private individuals. When we come to the point of corporate investors, so if you say, look, I have excess cash in my company, any taxation event. So again, if you invest and you contribute every year and you accumulate, normally there should be no taxable event. When it comes to a point of redemption or liquidation of your participation in the fund or a sale of shares, obviously there is the 25% standard corporate tax. When you qualify as an SME, it's the 20% instead. Any capital gains, obviously, and that's already the case today, they are liable for the Belgian corporate taxation. Has nothing to do with the solidarity contribution, that's a private thing. In this case, whatever a company does is normally, and whatever income she generates, even if it's capital gain, that is normally already into scope of the Belgian taxation. Now, in some cases, you have heard maybe about DRD funds. DRD funds are funds that qualify for the dividend received deduction. That's a bit technical. The idea is that if your fund is, let's say, distributing more than 90% of its as excess cash or excess money in the fund, then normally you would not be liable for corporate taxation in Belgium. There's a few other considerations as well. Now, the thing is that in this case, the fact that Altaroc works with the Luxembourg fund, the structure itself is not liable for corporate tax or any taxation in Luxembourg. So for that reason, the company or the fund would not qualify in your company for the DRD deduction. So that's something that you may pick up somewhere if you start reading about it, but in this case, would not work for the investments in Luxembourg. And again, also the securities accounts tax and what I mentioned before, the 0.15% is also applicable here for companies. So in a brief summary, there's an opaque treatment and it's a transparent structure. There is no taxable event unless we're looking at a distribution or a disposal of your participation. That could be withheld through 30% withholding tax, private individuals, or 25% for companies. If a 30% withholding tax is applied for companies, which is usually not the case, that will be recovered in the annual corporate tax filing. So the DRD deduction is not available if you invest as a company. And like I said, just to give a full picture, there may be some Cayman tax considerations, but following the recent decision from the Constitutional Court, should not be any particular issue in this case. Securities accounts, like I said, liable for the 0.15% annual tax if the value exceeds 1 million euro. So we have reached the end of presentation of today. We hope that it was, let's say, interesting, that at least it increased your understanding of private equity and everything that is involved. And I would say, if there are any questions, I'm going to check.
I saw already one question.
Okay, great. There's a few. I see.
The minimum.
Okay, no.
The minimum investment to step into one vintage is 250,000 euros in Belgium. If you're coming from another country, then it would be different. But in Belgium, it's 250,000 euros. I will make sure that Gregory, I'll discuss with Gregory to send a follow-up email to everyone that it was showed interest, because I see some people want to reach me directly, where you will have a link to plan a meeting with me one-on-one, and as well my contact details, so you can reach out to me directly. Expense rates of your vehicle, I think that will be as well something that we can take offline, and I can discuss what the rates are, because that depends on the amount you would invest, etc. So I can't give, I can say what the management fee is, but it might be that your investment is bigger, which makes it that would change. So we will, I think Gregory and I will work on a follow-up to everyone, that they have my contact details and they have some additional information and where to find me and plan a meeting with me.
Perfect. Okay, great. Well, Thibault, thank you for your insights. Thank you for your time. For everybody attending today.
Gregory, there's one question coming in.
Okay,
in order to invest with my company, is the business activity in that code's constraint?
No. So in essence, every company that is established in Belgium has a main activity, registered activity, but then additional to that, there's usually a few, let's say, side activities that are automatically included. So we'd have to check it, of course, in your specific case, Dennis, but normally any Belgian company can invest in these type of investments without having to adjust their company goal or activity. So that should normally not be an issue. So that hopefully that answers your question. If there are any more questions? Yeah, so like I said in the beginning, pending Thibault's approval, we will make our presentation available on our YouTube channel. We have the AI note taker as well that will give you a summary of what we discussed. Again, pending Thibault's approval, if we can forward it to everybody that attended today. And yeah, we will also send a follow-up email to everyone so they can get in touch with Thibault directly. Thibault, maybe just, you have your contact details on your slide, or maybe you can show something that where people can reach you? Or...
I don't have it on my slides.
No.
I would suggest we send my contact details out via email so everyone have it.
Perfect. We'll share it as soon as we can, and then you can get in touch with Thibault directly. Perfect. So if there are no further questions, yeah, we're within the 1 hour time slot. So that's always a challenge, but I think we all kept us to the time available. So everyone, thank you for attending, and yeah, hopefully we'll see you next event. Thibault, thank you again for your time.
Thank you very. Bye-bye.
Have a good day. Bye-bye.